I think given it's a midterm election year, historically you'd expect a little more choppiness into the elections and then a rebound afterwards. But, you know, the stock market trends up over time, so you should expect to hit all-time highs all the time. The important thing, I think, is that valuation levels are actually lower than they were at the beginning of the year because earnings growth has been so strong.
Well, that's good news for the folks that want to jump in. At least they're not doing it at the most expensive levels, perhaps. Vahan, what do you think about the general direction of the market right here? Do you agree with Jim?
Well, I am a little bit concerned that the market is getting a little bit toppy, and I'm also concerned about earnings. We've gone through a period of time of very strong earnings growth. Of course, this year earnings have really benefited by a number of things, including tax reform. I'm not sure that's going to continue. I think earnings forecast for next year might be a little bit too rosy. I know that there's a second tax reform package being considered right now, but that's more likely to benefit individuals rather than corporations. So I am a bit concerned that corporate earnings growth may be a little bit lower than expected.
So in that scenario, what do you suggest that investors should be doing with their portfolios, Vahan?
Well, you know, I am a bit of a contrarian. As a result, I'm often right, but I'm also often early. However, at this point right now, I am looking to favor things that are out of favor, and I'm marginally increasing my exposure to certain areas. In particular, I do like financials. I do expect the yield curve to steepen, whether or not the Fed continues with rate hikes at the lower end. And I'm also marginally increasing my exposure to emerging markets. Emerging markets, of course, have been whacked recently, and most emerging market funds have a very big exposure to China, and of course the Chinese market is way down. So I think this might be a good time if you're investing for the next 5 years rather than the next 5 weeks. It might be a good time to start increasing
Also on your
there.
list, Vahan, are two unloved and so far unmentioned by you stocks. Maybe they're unmentionable. Ford and IBM.
Well,
take me through Ford first, quickly, because I want to get the other guests back in.
Sure. I do like Ford. I've been increasing my exposure to Ford very recently. The stock's been killed for a number of reasons, including higher raw material costs because of tariffs, and also their inability to sell cars in places like China because of tariffs. But I think these tariff disputes will eventually be settled. And of course, Ford is now focusing more on the more profitable areas, such as SUVs and pickup trucks. So from a long-term perspective, I think it's a good time to start getting in.
You know, Ford and financials are two areas in the markets that theoretically, at least on paper, should do extremely well given where the economy is and where the consumer is. Jim, I want to go back to you because you like Citi, so that falls into the financials group, which has been underperforming the market, even at a time when the economy supposedly is very strong. The consumer is strong. Corporations have great balance sheets, should be willing to take on loans, et cetera. Why do you think Citi has had so many headwinds so far in this trade when it seems like everything should be going in their favor?
Well, everything, if you look at the numbers, a lot of things have gone in Citi's favor. In fact, that's where we think the opportunity is. It kind of went into the crisis with a lot more of the toxic assets that it's largely cleaned up. So we think that's kind of an opportunity. If the bet on financials, if they get ROEs up to half of what they were prior to the crisis, you get a lot of upside, the most in Citigroup. So it's not a heroic bet. There's a lot more upside than downside to Citi right now. We're seeing revenue and loan growth across both their main business segments.
Jim, you've had you also have a pick here in the energy sector, which has actually had a pretty good week overall. The sector, what names do you like there?
Well, at South Texas, I like to point out that we think you should own some names in every sector. And in energy, we like names that you don't have to make a heroic oil price bet. Refiners is a good place to look there. And we like Marathon Petroleum, really the largest after the acquisition of Endeavor, the largest refiner in the country. And there's a lot of new stringent fuel requirements coming down the pike, particularly with global shipping, that require a lot more refining capacity. So we think Marathon Petroleum is well positioned and at a good value right now.